You open your banking app, you check your balance, and for a second you think, maybe this month I'll finally do something with this money. Then you close the app and do nothing. That moment happens millions of times a day. People intending to invest, people meaning to start, people telling themselves, next month when things settle down a bit, and next month becomes next year, and next year becomes a decade of missed compounding that you can never get back. This is the story of what happens if you don't wait. This is the POV of the version of you that starts today, at 28, with just $200 a month. Let's walk through it. You're 28 years old. You have a job. You're not rich. You're not broke. You're somewhere in the middle, paying rent, covering your bills, maybe going out on weekends. You are, statistically, the average person in their late 20s. And right now, today, you make one decision. You set up an automatic transfer of $200 a month into a low-cost index fund. You don't try to time the market. You don't pick individual stocks. You just buy a simple, diversified fund that tracks the total market, something like an S&P 500 ETF, and you let it run. $200 a month. That's $6.67 a day, less than 2 cups of coffee at a city cafe. You won't even notice it after the first month. The S&P 500 has returned an average of roughly 10% per year since its inception, closer to 7% after inflation. Markets go up, markets go down, but over long time horizons, 20, 30, 40 years, the average has held. So let's use a conservative 8% average annual return. At 28, you start $200 a month, 8% average return. By the time you're 38, 1 decade in, your account has grown to roughly $36,000. You personally put in $24,000. The market added $12,000 on top. That gap between what you contributed and what the account holds is your money working while you sleep. By age 48, your account has grown to approximately $117,000. You contributed $48,000 of your own money. The market added nearly $70,000 on top. The gap is now larger than what you put in. That is compounding crossing a threshold. And by the time you are 58, your account approaches $358,000. Your total personal contributions over 30 years? $72,000. The rest, nearly $286,000, is returns built on returns built on returns. Your money is doing the heavy lifting now, not you. This is what Albert Einstein reportedly called the 8th wonder of the world, compound interest, not the money you put in. The relentless snowball of growth stacking on top of growth, year after year. Here's the number that should stop you cold. If you wait just 5 years, if you start at 33 instead of 28, everything else identical, you arrive at 58 with roughly $238,000 instead of $358,000. A 5-year delay costs you $120,000. The 5-year contribution difference is only $12,000. The other $108,000 is time you can never buy back. In his book, The Psychology of Money, Morgan Housel points out something most people miss about Warren Buffett. His genius is real, but the majority of his net worth wasn't built in his youth. It was built after age 65, when the compounding engine had enough fuel behind it to generate numbers that look almost unreal. The lesson isn't stock picking. The lesson is time. You may not be Warren Buffett, but you are 28, and that is a significant asset. Now here's the part that trips people up. Most people think building wealth means earning more, a promotion, a side hustle, a raise, and those things matter. But Thomas Stanley spent decades studying American millionaires for The Millionaire Next Door and found something surprising. The majority didn't live in the richest neighborhoods or drive the newest cars. They lived below their means. They invested consistently. They didn't look wealthy. They just quietly built it. Meanwhile, people earning twice as much often had less wealth, because they scaled their spending to match their income. Every raise, a bigger apartment. Every promotion, a newer car. This is lifestyle inflation. The gap between earning and investing disappears, and so does the future. Your $200 a month doesn't require a high income. It requires a gap, a protected, non-negotiable gap between what comes in and what gets invested before you spend the rest. Behavioral economists call this paying yourself first. David Bach's research showed that automatic pre-spending investment transfers dramatically improved long-term savings rates. When the money moves before you see it, It disappears from your mental budget. You adapt, you spend what remains, and quietly the fund grows. So here's what you do. Today, you open a brokerage account, Fidelity, Vanguard, Schwab. You choose a broad index fund with a low expense ratio. You set up an automatic monthly transfer of $200 on the day after your paycheck lands. And then you do not touch it. You do not sell when the market drops and the news says the sky is falling. Markets will drop. They always do. The DALBAR Institute's annual study has found consistently that the average investor underperforms the market not because they chose bad funds, but because they panicked and sold during downturns. The fund performed fine. The investor's behavior didn't. Staying the course is the strategy. $200 a month, starting at 28, at 8% average annual return. By 38, $36,000. By 48, $117,000. By 58, $358,000. By 65, approximately $600,000. $600,000. From a habit that costs less than your streaming subscriptions. From a decision you make once and automate forever. The 65-year-old version of you will remember this moment. They will remember it was $200. They will remember it felt like almost nothing. And they will know with complete clarity that almost nothing became everything. You open your banking app, you check your balance. This time, you do something with it.